Now to Dollars and Cents, a weekly special report where I find answers to your money questions. Spring is the hottest season for home buying. An important tool for home ownership is your credit score. Viewers have written in, rattled by claims that they've seen online, saying a high credit score won't get them as much as it used to, thanks to changes by the government that started May 1st. Critics argue buyers with good credit could essentially subsidize those with bad credit. According to experts I talked with, yes, these changes will touch a lot of people, but maybe not in the way you think.
Buying a home and owning a home is the American dream.
New changes are now in effect to help make that dream a reality for more people.
And this is the most significant financial transaction you'll make in your entire life. And if you're a first-time home buyer especially, it can be overwhelming.
And expensive. So the federal government put into place a new mortgage fee structure this spring. It's meant to help lower the fee gap between borrowers with high FICO credit scores and those with lower ones by reducing their closing costs.
That would give them more room to have more buying power and be able to purchase.
Here's what happened. The Federal Housing Finance Agency recently updated a pricing structure that applies to about 80% of the mortgage market, loans originated by Fannie Mae or Freddie Mac.
The changes are really to what's called loan level price adjustments, and that's how Fannie Mae and Freddie Mac, they impose risk-based pricing, and these are hits to pricing based on your credit score, based on your loan to value, based on your potential overall risk to them as a borrower.
And despite what you see online, this isn't necessarily a new fee. Lenders have had to deal with the changes months before the official rollout announced May 1st. Plus, the impact to creditworthy borrowers is probably less significant than you've been led to believe.
There's a misconception out there that now people with lower FICO scores can get a better rate now based on this than someone with a higher FICO score. And that is not the case.
Do you think that these changes could have a true impact of that goal that they're trying to achieve?
Yeah, I mean, I would say that in certain instances, a potential first-time home buyer could lower their monthly payment based on these changes by maybe $50, $60, $75, depending on their loan amount, and that could help them qualify for a loan that they otherwise wouldn't qualify for.
But these fees levied by the FHFA have caused uproar among some mortgage professionals. The Mortgage Bankers Association came out against the overhaul, saying it, quote, is unworkable and should be removed. The backlash to the overhaul spurred the agency, which levies the fees, to issue a recent statement calling such concerns, quote, a fundamental misunderstanding.
Good credit to keep having good credit, and then the people who have not so great credit they're giving them an opportunity to purchase, but are they able to handle the mortgage on top of all the bills that come along with it?
Right.
These fees are important for you to know because a down payment isn't the only thing you're bringing to the table when buying a home. Closing costs are expenses you pay to your lender in exchange for loan services. Closing costs usually make up 3 to 6% of the loan amount, meaning if you take out a mortgage worth $200,000, you can expect your closing cost to be about $6,000 to $12,000.
It's an important factor to purchase a home, and I believe every family should have one because it is their foundation for their family and to grow up, to have memories.
Don't let this discourage you from buying a home. Educate yourself, get a good loan officer that can help you learn the nuances of this, because this is very nuanced.
If you already own a home or have a mortgage in place, before the changes launch this spring, you won't be affected. This new mortgage fee schedule applies to new home purchases.
And you know what? Some people may be thinking the unthinkable, huh? Should they try to lower their credit scores to take advantage of the lower rate?
Right. Chris, the answer is a hard no, right? Damaging your credit score can ruin other prospects for yourself, like getting better rates on car loans or credit cards. A high credit score is still one of your best tools to financial success. And the experts tell me, at the end of the day, only buy a house that you can truly afford. And remember, you can always refinance later.
Certainly a good point. That's Dollars and Cents for you.
Yes.